Previous couple of videos, I covered how to know, or at least be confident, that your CGS and your ending inventory amounts are accurate. In this video, I'll cover the impact on the accounting records when our amounts, specifically ending inventory, are misstated. A firm with a merchandiser client, or if you work for a merchandiser directly, you'll almost certainly be involved in an inventory audit at some point in time. Inventory audits are just a fancy way of saying that all physical inventory must be counted. These counts should be conducted at least once a year, but some companies may have both an in-year audit and a mid-year audit. Counting your merchandise inventory to make sure your records are accurate is a good means of preventing theft. Any potential thieves in your employ may be less likely to steal if they know inventory discrepancies will be identified and investigated. I tell this story to my students as a good illustration. Years ago, I had an associate who had a client who owned a restaurant. This client had a very significant increase in the cost of meals being sold. So he conducted an investigation. Perhaps food was going bad and needing to be thrown out because there was something wrong with the refrigerators, or maybe the food was being stored incorrectly. What he discovered was that after hours, some of the employees were getting together and having dinner parties, basically, at the restaurant's expense. Perhaps if they knew about audits, those former employees of his would have made better choices. Beyond preventing theft, audits are essential for ensuring accurate accounting records. The amount of inventory reported on the balance sheet needs to be that actual amount that we own. Otherwise, the company is lying about how much assets it has and committing fraud for which it can be legally liable. In a perfect world, the inventory we count would perfectly tie to our records of that merchandise. But very seldom will those two figures match. This discrepancy is known as shrinkage. To illustrate, imagine we have the following merchandise inventory. These are supposed to be boxes of inventory, so please use your imagination. Pretend that a physical count of merchandise shows our company to have $44,000 worth. However, when we compare that number to our general ledger, our records say that we only have $46,500. We can't report that $46,500 on our balance sheet because we would be lying about how much merchandise we actually have. So we need to adjust our ledger balance to the true amount. In other words, we need to post a credit to merchandise to reduce its balance to $44,000. To achieve this effect, we'll record a journal entry that includes one such credit to merchandise. Which account will we debit for $1,500? This may vary depending on your instructor or your textbook, but my course puts it to cost of goods sold. That said, please utilize whichever account your professor tells you to. Now, our merchandise inventory record is accurate and can be reported to the investors via our financial statements. How do we know whether an item of merchandise should be included in our physical count? After all, we don't do ourselves a favor if our merchandise inventory balance is still incorrect after our shrinkage adjustment because we counted wrong. The intuitive reasoning is the correct one. We include all merchandise the company owns, regardless of its location. Items of particular interest include goods in transit, goods on consignment, and damaged merchandise. Regarding goods in transit as of the date of the audit, we need to be cognizant of such inventory shipping terms. Merchandise inventory purchased under terms FOB shipping point needs to be included in our inventory count. After all, that merchandise became ours as soon as it was loaded onto the truck. Goods shipped FOB destination are not included, since they won't belong to us until they reach our location. Goods sold on consignment are not actually ours. These are goods we're selling on behalf of another party, and then charging him or her a fee for that effort. Years ago, I had a piece of fitness equipment I hadn't used in a while, so I took it to Play It Again Sports. The salesperson offered to either buy it from me for $100, or I could get significantly more money if I sold it on consignment. Under the latter option, it would still be mine until a customer bought it, at which point Play It Again Sports would charge me a small fee for allowing me to use its floor space in order to find a buyer. I chose to sell on consignment, so when Play It Again Sports did its inventory count, that item was not included. I figured I didn't mind waiting to get paid more money. Then I completely forgot about it and never got paid at all. My point being, since the company doesn't legally own this inventory, it should not be included in the physical count. Lastly, we have damaged merchandise. Imagine you have a particular item or classification of inventory that gets damaged for some reason. Say that a pipe breaks and the inventory suffers water damage. It can still be sold as opposed to being thrown out, but this damage has lessened its value. In such an instance, we have to write off a portion of its cost to reflect that decline. For example, if that water damage reduces a $200 item's value by 25%, we'll have to write down the inventory by $50. I make my class use the same entry for shrinkage. Debit cost of goods sold and credit merchandise inventory for the amount of the damage. But please confer with your instructor for your class's correct debit account. The impact of misstatements in our inventory counts. Once again, we'll be using our formula. However, for this topic, we can best understand the error's impact if we solve the formula for cost of goods sold. Imagine the actual amounts for these variables in year 1 are $700 for beginning inventory, $500 for purchases, $300 for ending inventory, and $900 for cost of goods sold. However, when preparing for year 1's financial reporting packages, while our records have the correct amounts for beginning inventory and purchases, we made a mistake when counting ending inventory. Specifically, we didn't include certain items in our physical count, perhaps by overlooking goods in transit. The consequence: ending inventory is understated by $100, and that error will make cost of goods sold overstated by $100. Cost of goods sold is an expense, so when we build our income statement, using the correct cost of goods sold would provide a net income of $2,100, but our overstated cost of goods sold would result in an understated net income by that $100 difference. If you're wondering about the $3,000 in revenue, I just pulled that number out of thin air. You could pick any number for revenue, and the reported net income would still be understated by this $100 difference. The ending inventory variance will also show up on the balance sheet. Specifically, it'll show up under assets. Remember, ending merchandise inventory is a current asset. Recall how the balance sheet represents the accounting equation. Our accounting equation must always be balanced. If we have an understatement on the left side of the equation, then we must have an overstatement on the same side of the equation in a different account, or an understatement on the opposite side of the equation. So where will that opposite effect be? Remember how net income flows into the balance sheet. We'll incorporate net income in the statement of owner's equity. Here, this $100 understatement in net income will carry forward into a $100 understatement in the ending owner's capital. And this amount will go on the balance sheet under equity. So equity will contain the other half of this misstatement. That was year one. What's the impact of this error in year two? Keep in mind that last year's ending inventory will be the current year's beginning inventory. So last year's $100 understatement will show up here for year two. If we make no mistakes in recording our purchases or in conducting our count of this year's ending inventory, this year's cost of goods sold will end up understated by $100. Feel free to pause the video here and confirm the math. Now, when we build year two's financial package, net income will be overstated as a result of understating cost of goods sold. As in the last slide, the $1,000 revenue is an arbitrary number. You could swap it out with any number and the overstatement would be identical. When we build our statement of owner's equity, we'll see net income's overstatement here. But note that just like beginning inventory, this year's beginning owner's capital is last year's ending owner's capital. Consequently, since last year's ending owner's capital was understated, this year's beginning owner's capital will be much the same. Last year's understatement will combine with this year's overstatement to yield the correct ending owner's capital. When we come to our balance sheet, both our assets will be correct, since ending inventory is correct, and equity will be correct as we observed on the statement of owner's equity. After 2 years, any single miscounts in inventory will have worked their way through our reporting packages, and the financial statements will be correct, barring no other errors. Your textbook will likely summarize the impact of ending inventory misstatements, as in the table you see before you. I would advise you not to waste much effort in memorizing any such table. Instead, use this method I demonstrated previously, analyzing the error in terms of the equation and how it flows through the financial statements. I realize it's a bit of pencil work, but it reinforces a cohesive principle that will allow you to reason through any relevant question. That concludes this video on inventory misstatements. Next time, we'll go over the lower of cost or market valuation for merchandise. Thank you very much for watching. If my videos are helping you and you want to return the favor, you can leave a thumbs up, as well as a question or a comment below. If you really want to help, temporarily subscribe for however long you're taking your accounting courses. Finally, share my videos with your fellow classmates and even your professor. I'd like my videos to help as many students as possible, and I wouldn't mind getting some feedback from contemporaries. Thank you once again, and I'll see you in the next one.